All right, let's get right into it. Today, we're diving deep into one of the most technically demanding and, frankly, one of the most critical areas of federal tax law, how we classify agricultural income. Now, this isn't just about picking the right form. This is a massive strategic decision. Get it wrong, and the financial consequences can be huge. The choice between filing a Schedule F versus a Form 4835 is pretty much the main thing that determines whether you're on the hook for a very specific and very significant tax.
And there it is. 15.3%. That's the self-employment tax. This single number is really at the heart of our entire conversation today. It's the rate that comes from the Self-Employment Contributions Act, or SECA, and it's what draws the line in the sand between an active farm operator and a passive landlord in the eyes of the IRS. Choosing the wrong form here can mean a really nasty surprise in the form of a substantial tax bill.
So this table lays out the three key players in this whole decision. You've got Schedule F for your active, hands-on business income. Then there's Form 4835 for passive crop share rental income. And finally, Schedule E for just straight-up fixed cash rent. But look at that last column. That's the kicker. Schedule F is the only one where self-employment tax comes into play. And it all boils down to that middle column, your level of participation.
To really get our arms around this, we're going to follow a pretty clear roadmap. First, we'll talk about why this is such a high-stakes choice and the rules behind it. Then, we are going to get into the real nitty-gritty of the material participation test. After that, we'll compare the tax implications side by side, uncover some of the hidden benefits of being an active farmer, and then wrap it all up with strategy and compliance tips to keep you on the right side of the IRS.
Okay, so let's start with the regulatory framework. This is so much more than just a little administrative detail. How you classify your farm income is a foundational decision, and it's rooted directly in the Internal Revenue Code. It's a choice that's going to dictate your tax liability, what deductions you can take, and believe it or not, even your long-term estate planning.
First up, let's talk about Schedule F. Think of this as the main form for the active business of farming. This is for taxpayers who are truly operating the farm, and the IRS has a pretty broad definition here. It covers everything from nurseries to ranches to orchards. The bottom line is, if you are bearing the financial and operational risks of the business and your net profit is over $400, this is your form. And that means self-employment tax is part of your reality.
Now let's look at its counterpart, Form 4835. This form has a very specific, very important job. It's designed for landowners who rent out their land under a crop sharing agreement. That means their rent is based on a share of whatever's produced. But, and this is the crucial part, they do not materially participate in running the farm. That's the key. Because there's no material participation, that income is not subject to self-employment tax.
And rounding out our trio, we have Schedule E. This is really the most straightforward of the bunch. It's for landowners who lease out their property for a fixed, preset cash rent. Like $300 an acre, paid whether the crop booms or busts. In this scenario, the landlord's income has nothing to do with the farm's success. That makes it purely passive rental income, which is never, ever subject to self-employment tax.
And this brings us right to the heart of the matter. The entire system for reporting farm income really rests on this one single legal concept: material participation. This is the threshold. It's the bright line that the IRS draws to separate a passive landlord using Form 4835 from an active operator who belongs on Schedule F.
So what exactly is material participation? Well, the IRS defines it as your ongoing and substantial role in the farm's operations. It isn't about just one thing either. It's a whole picture. They're looking at your involvement in the physical labor, the management decisions, your financial stake, and how much time you're putting in. If you cross this threshold, there are immediate and mandatory tax consequences. It's not optional.
Now, specifically for self-employment tax on farm rental income, the IRS gives us 4 very specific tests right in Section 1402. And you only have to meet one of them to get your income pushed over to Schedule F. Now, Test 2, that's the one that often becomes a trap for retired farmers. If you're still the one making the final call on what seed to plant or when to sell the grain, guess what? You are materially participating. It's not just about physical labor, it's about who has management and control. And this whole idea fits into a much bigger picture under Internal Revenue Code Section 469, which deals with all passive activities. There are actually 7 tests in total, but these are some of the most common ones. And you really need to pay attention to that last one, the 5 of 10 year test. A farmer who is active for decades can't just flip a switch and become passive overnight. For 5 years after they stop meeting the other tests, the law can still see them as active,
which means their crop share income could still be subject to SE tax even after they've officially retired.
Okay, so we understand the dividing line. Now let's really dig into the financial trade-offs. This next part is where we compare the tax consequences of filing Schedule F versus Form 43-5 head-to-head. And trust me, it's about a lot more than just that 15.3% SE tax.
This table is a fantastic summary of what you're weighing. With Schedule F, yep, you pay the 15.3% SE tax, but you completely avoid the 3.8% net investment income tax, or NIIT. You also almost always get to take the 20% qualified business income deduction, that's QBI, under Section 199A. Now, with Form 4835, you dodge the SE tax, but you might get hit with that NIIT instead. Plus, your QBI deduction is a bit of a question mark, because your rental activity might not be considered a full-blown trade or business. And look at the passive loss rules. Active losses from Schedule F can offset your other income, but passive losses from 4835? They're trapped. They can only offset other passive income.
And this brings us to a really tricky, high-risk area, self-rental. You might think, hey, I'll own the land myself, lease it to my own farming S-Corp or LLC, and just take that rent as passive income on Schedule E. Well, not so fast. The courts, especially in a case called Mizell v. Commissioner, created something known as the Mizell Trap. Basically, if that lease is just part of an overall arrangement where you're still materially participating in the farm itself, the IRS can come in, recharacterize that rent as active income, and slam you with self-employment tax on it.
So far, Schedule F might be sounding like a big tax bill you want to avoid, but let's flip the script for a second. There are some incredibly powerful advantages that you only get by filing as an active farmer, benefits that can actually be worth way more than the cost of that self-employment tax. Take a look at this number. For 2024, this is the maximum amount of equipment costs an active farmer can choose to deduct immediately in the year of purchase, under Section 179 of the tax code. We're not talking about a deduction spread out over years. This is an immediate, massive boost to your cash flow. And this comparison right here shows you the real-world power of that advantage. As an active farmer on Schedule F, you can buy that brand new combine and write it all off right away. But a passive landlord on Form 4835, they generally fail the active conduct of a trade or business test that Section 179 requires, so they have to capitalize that exact same expense and depreciate it slowly over 7 or even 15 years. The difference in tax savings and cash in your pocket is just enormous.
But wait, there's more. The benefits don't stop there. Paying self-employment tax on Schedule F is literally how you earn your Social Security credits for retirement and disability. It's also the only way to get access to specialized deductions like Section 175 for soil and water conservation. And, this is a big one, net profit on Schedule F is considered earned income. Why does that matter? Because it's what you need to contribute to powerful retirement accounts like a SEP IRA or a solo 401k.
Now, I want to give a pretty serious warning. We tend to focus on this year's tax bill, right? But the choice you make on these forms has profound, long-term consequences. A consistent history of filing as a passive landlord on Form 4835 can completely lock your estate out of some of the most powerful tax-saving tools available to farmers.
This table shows you exactly why that warning is so important. Look at Section 2032A, Special Use Valuation. This can slash an estate's value by nearly $1.4 million. But here's the catch. The decedent or a family member had to have been materially participating for 5 of the 8 years right before they passed away. And then there's Section 6166. This is a lifeline for so many farm families. It lets you pay your estate taxes over 14 years. But it's only available if the farm was an active business, not a passive investment. And what's the #1 piece of evidence the IRS will use to deny these benefits? A history of you filing Form 4835. All right, for our final section, let's bring this all home. We'll focus on how to apply this in the real world with some clear examples and concrete advice to make sure you're compliant and ready to defend your choices if the IRS ever comes knocking. These scenarios with Frank and Paula just make the rules crystal clear. When Frank is running his own farm, boom, Schedule F. When Paula rents her land for a fixed cash price and has zero involvement, that's a classic Schedule E. Now, when Paula takes a share of the crop but stays completely passive, that is the perfect situation for Form 4835. But the second Paula becomes materially involved in that crop share, making decisions, providing labor, she has to switch right over to Schedule F and pay the self-employment tax.
So how do you stay out of trouble? First, get everything in writing. A formal, written lease is your best friend. Second, keep ridiculously good records. If you have a self-rental deal, you better be able to prove that rent was actually paid. Third, be smart about how you structure your entities. And finally, watch your expenses. If you're deducting fuel or machinery repair on a Form 4835, you're basically sending a postcard to the IRS that says, "Hey, I'm not really a passive landlord."
And we'll end with this question, because it really gets to the absolute core of the issue. It's the strategic dilemma that every single landowner and their tax advisor has to grapple with. Is the short-term, very tangible goal of avoiding that 15.3% tax today really worth the long-term, potentially catastrophic risk of losing out on Social Security, powerful deductions, and literally millions of dollars in estate tax benefits down the road? That's the calculation that truly matters.